Ladies and gentlemen, welcome to today's episode where we're breaking down two key earnings plays, Boeing and United Healthcare. Let's get to it. Two things you need to look out for when doing any earnings report. What investors are looking at is revenue and earnings per share. Revenue is how much money a company is bringing in overall, and earnings per share is how much profit a company is bringing in. So how much are they making after all the costs is set and done? So let's take a look. Okay, so now Boeing is where it gets spicy. When we break down Boeing, we have earnings per share year over year up 268% and revenue up 57% year over year. We beat estimates. This is absolutely amazing. Almost $10 per share in profit. This is crazy. That's not a bad beat. Okay, so revenue is up, profits are up, and Boeing just showed signs that they are finally fixing past mistakes. So what did I do? I went into the stock. This is Boeing right here. Now look at the volatility that we have going on today. It dropped off. What are investors scared of? There is something that we're missing, because when we look at this earning report, we're like, holy cow, this is incredible what they're doing, but we're selling off. We're struggling a little bit. So what I did is I bought this dip where the blue line is right here. I'm going to zoom in the morning time. I bought this dip. It skyrocketed to this pump right here, and I was able to sell for profit. Okay, so now let's go over to United Healthcare. What are we seeing right here? We're seeing a miss. We see earnings per share, their profit that they're making is down 69% year over year, but the revenue that they're making, hold up, it's up 12% year over year. So money is coming in, but they are struggling to make a profit because it seems like cost potentially may be going up. Let's think of it like this. Imagine owning a grocery store. People are lining up, sales are up, but the cost of your products that you're selling is also doubling. Payroll is doubling as well. So even though they are busy, they're staying super high in revenue, they're making less money because their cost is going up. So this is interesting to see, but I still think it's a good long-term play. So how did we play it today as a day trade? Well, again, it got slammed kind of like Boeing here, but then it consolidated at this bottom here. So let me show you. This is where we call our support lines. This is our support lines right here. So we drew a support line level and we said, okay, hey, this eventually will recover. I don't think that it's going to continue to sell off. It's kind of just consolidating. And this thing gapped down like crazy. If we take a look at the overall 30-minute chart, look at this. This is absolutely insane. From highs of $350 all the way down to $281 per share. This is why I thought it was a good dip buy, that it was going to have a couple of pops today, because that's literally a 20% sell-off. I chose to day trade in these companies, which gave me $500 worth of profit. Absolutely phenomenal. I'm so thankful for that. It's been an incredible day. Would I choose to invest long-term in these companies? Honestly, I think based off of these earnings, I think yes, I would choose to do a long-term trade in these. And for the long term, I mean, this thing is and will recover, I believe personally, just based off of what we've seen in the past. It eventually does bounce up and does recover, and you can make a profit off of these companies. Hey, if you don't know who I am, my name's Ty. I'm building a community where we can elevate our wealth and grow together. So come check it out, and I'll see you on the next video.